a forensic accountant, and I've been with the firm for 13 years, straight out of college. And really what my specialty is in forensic accounting is fraud prevention, fraud detection, and fraud investigation. And really today we're going to be talking and focusing more on the prevention side, and especially how it relates to the construction industry. And I'll give some examples on things that we have seen in the construction industry, and maybe ones that are related to construction as well. And you can see there, I've conducted hundreds of investigations. I've probably been involved or had my hand in thousands of them, but when it comes down to ones I've been intimately involved with, it's probably about 500 or 600 investigations. I would say about 75% of my time is spent actually investigating frauds that occur within companies. The other 25% is doing what I would prefer lots of companies do, and that's the prevention consulting. So that's kind of talking about what we're doing today. So I implore all of you, because this is I think a good step for any organization to understand how to prevent fraud and why fraud occurs. And that's kind of some of the things we're going to talk about. So we'll move forward. And just so you guys know, that is my contact information, my email, and my direct line here at the office. If you have any questions, after the presentation, next week, next month, please feel free to contact me. I'd be happy to answer any questions that you have. So as an introduction, and I always like to bring this up every time I speak, I like to talk about what fraud is, because I think that term gets thrown around a lot. And a lot of people may use that term and they may not understand really what fraud consists of. So at least in the context of what we're talking about, and I'll kind of label it as employee theft, fraud really needs to meet four criteria in order to be consistent with fraud, at least in the legal sense. And you can see that definition up on your screen. Really what fraud is, it's an intentional deception made for personal gain or to damage another individual. And like I said, with what we need to kind of identify and define fraud, we need four things. And one of those things is it's got to violate the perpetrator's fiduciary duty. So as employees of a company, we all have a fiduciary duty to do what's in the best interests of our organization. And it doesn't mean we don't make mistakes, right? I mean, sometimes we will make mistakes. We might cost our organizations money, but it's not intentional. So that's another thing I want to show, is that it's got to be intentional. It's got to be something that they did on purpose, not a mistake that was made. And then the second point there, it's got to be committed for the purpose of a direct or indirect financial benefit. And the reason we say indirect financial benefit is I've actually worked several cases where the person that's committing the fraud isn't the one that's benefiting from the fraud. So it's very interesting. Occasionally we'll have cases where someone is committing an embezzlement scheme, and they're actually using those funds to benefit somebody else. A lot of times it's a family member or a friend. Usually it's with, we've seen it before, where they're helping with medical bills for family members, student loans for family members, things like that. Someone's got to receive a benefit, basically, what that comes down to. The other thing is it's got to cost somebody something. So usually it's the organization that's being defrauded is who's suffering that loss. So it's got to violate our fiduciary duty. Someone's got to receive a benefit. Somebody's got to receive a loss. And then the kicker here is that it's got to be hidden or concealed. So that's kind of where the intent comes into play. Something that's trying to be hidden, trying to be concealed, really does help prove intent. And we'll get to that later as well. But this is kind of the real true definition of an employee theft or a fraud scheme. Now, why do people steal from their employers? And I like to talk about this as well almost every single time I speak, because it holds true almost 90% of the time we have a case that we work on. And it's this fraud triangle that was developed in the 1950s, and it still holds true today. But it really indicates that there are three reasons why a fraud will occur. And you can see there, opportunity is one of them, and I want to talk about that one first. So in order for fraud to occur, someone's got to have opportunity. They have to have, just examples, access to cash. They may, maybe they're in a purchasing department and they're able to disperse funds. Maybe they have authority to utilize certain monies or assets or equipment, things of that nature. So they have to have opportunity. They have to have access of some kind. The other one on the left there would be pressure, and that one is usually related to some kind of financial issue, some kind of financial pressure that they have. I will say that in most cases, about 2/3 of our cases involve a gambling addiction. So it's kind of a high number, about 2/3 of our cases, gambling addiction. But if you think about, anywhere you are and wherever you're from, the Midwest, um, the West, the East Coast, everyone's probably within an hour of a casino or some place where they can gamble. And what we've identified is that gambling addiction is ripe for committing fraud because people feel that they can pay it back by winning. So the intention may not initially be there to steal or embezzle thousands and thousands of dollars. The intention may just be to steal so they can satisfy their addiction and then pay it back with winnings that they intend to win, which, as we know, usually does not happen when you gamble. So pressure, usually a lot of other ones that we see, just financial pressure, lots of debt, people getting divorced. A lot of times we see that being a lot of pressure. Usually the financial situation starts to change for that individual. Lots of medical bills is another reason that we see it. And then we do occasionally see people that have that just want to beat the system mentality, but that's actually very few of our cases. And then lastly, the last part of the fraud triangle that's really kind of the kicker is rationalizing the behavior. So you have to have opportunity, you have to have access, right? You have this financial pressure, but then you also have to have that inner dialogue inside of you that says that you're rationalizing this behavior. And some of the rationalizations that we hear of, pretty common, I'm just borrowing it, I'm going to pay it back. That's a big one. They owe it to me. Maybe I didn't get my raise this year. Maybe I didn't get my bonus that I was expecting. Maybe I'm doing a lot more work than I used to do. I know when there was the financial crisis in 2008, 2009, 2010, that time frame, we were seeing a lot of people doing a lot more work for a lot less money. And so they weren't getting their usual raises. They weren't getting their usual bonuses. People were getting laid off, so you had other people doing more work. So these people were rationalizing their thefts through that. And those are just some of the rationalizations we hear, but just to give you an idea. So that's kind of the fraud triangle. Again, it kind of says that fraud doesn't occur unless you have these three items. And moving forward, so talking about the median losses per fraud scheme, it's kind of interesting to see these numbers. And I have a certified I'm certified fraud examiner and certified in financial forensics. And through the Association of Certified Fraud Examiners, we actually do a biannual survey where they email all of us and they get all of our information in terms of what kind of schemes we've been seeing, and they get all kinds of details from those schemes in terms of the industry, the amount, the the employee level, where it happened, and they compile all this data and they release this report to the nations, and it's every 2 years. And this is kind of where we get these statistics, and it's very interesting to see. And you can see here per fraud scheme, owners and executives, the median loss is about $850,000, which is extremely high number. And you can see for managers, it's about $150,000 per scheme, $50,000 for employees per scheme, and then we kind of threw in there for the construction industry, the average fraud scheme, the loss is about $227,000 for the construction industry. And I'll say if the work that I perform for all industries, I would say the average is probably around $150,000. It's amazing how fast that amount climbs during a fraud scheme, and it's amazing how the perpetrator has no idea that they've taken that amount of money. A lot of times they think it's less than half of what they've actually taken because they just have no idea how much they've stolen. Some more statistics I thought were very interesting. 89% of fraudsters had no prior fraud conviction. 85% displayed at least one of the following behavioral red flags. So we call them behavioral red flags. And this means, in hindsight, after these people have stolen money or committed a fraud or an embezzlement within an organization, these companies look back and they say, yeah, they were living beyond their means, or they had a lot of financial difficulty, family issues, or control issues. A lot of times when people are committing a fraud scheme, they can't leave their job. They can't leave or take a vacation. They can't let anyone else touch their work, because if they do, someone's going to find out. So you'll see a lot of times people have a lot of control issues, don't let anyone else do their job. And I thought that was kind of interesting and a good thing to note. And also going back to the 89% of fraudsters had no prior fraud conviction. It's really most fraudsters don't have a prior criminal history at all. So they're very common people like you and I, middle class individuals who are falling into these fraud schemes. Usually it's because of that financial pressure we talked about happening in their personal life. And whether that's an addiction or whether that's a financial debt, either way, that's kind of the driving force in all of these fraud schemes. So again, employees generally, and this kind of relates back to the other slide that we looked at, generally speaking, the longer you're with a company, the more you're able to steal. And usually that's related to the fact that, one, you're probably, the longer you're with a company, the more authority you end up having, the more trust you're building. So you're seeing that people with less than a year at an organization, the median loss is about $40,000, which by no means is a small amount of money. 1 to 5 year tenure, and on average, is about $100,000. And people with their organizations 6 to 10 years is about 173,000. And then more than 10 years is about 241,000. So the longer you are with a company, again, the more trust you're building with that organization, the more authority you're gaining. You're probably getting promoted. You're probably in a management position, and then all the way up to an owner maybe, or a CEO or CFO. So polling question number 1, I believe they will be able to answer on your computer, but the question is true or false. Fraud is an intentional deception made for personal gain or to damage another individual. Nice work. So fraud and intentional deception made for personal gain. The answer is true. That is the short definition, although we did give some other points that need to be made to kind of define fraud. That is if you were to look up maybe in the Webster's dictionary, this is kind of the actual definition you'd probably see. So good work. So going to red flags of fraud. So these are things that you can kind of look for. And again, when we talk about red flags, that's really what it is, and that's really all it is. It doesn't mean a fraud is occurring. It really just means this is an alert, something that you should probably look into. Does not signify a fraud is actually happening. But some red flags that you should look for. Some of these are pretty obvious. Missing inventory is a big one, and I would say with construction especially, you have a lot of that issues. I know that we see a lot of scrap going missing, being sold under the table by all levels of employees. I know that not just missing inventory, but missing tools is another one that we see a lot of, equipment, and these can be expensive items, and these are all red flags of fraud. Now, do tools go missing and do supplies go missing where there's no actual fraud or intent? Absolutely. But again, these are red flags, not necessarily saying that a fraud is occurring, but things that you should be aware of. And I'm sure some of these, especially in construction, you're very aware of missing inventory and equipment. Cash flow problems. This is probably one that can sometimes go unnoticed. So you should be making money. You feel like your company's doing well, or you feel like you shouldn't have any problem paying your expenses, but for some reason you can barely make payroll. And why is that? Why with good sales and keeping your costs low, why you guys continuing to have cash flow issues? And that's a red flag. Records not produced on demand, or indicating that source documents are lost. And when we're talking about source documents, we're talking about bank statements, sales or accounts payable invoices, things like that go lost or missing. If you're trying to figure out why you paid a certain vendor $10,000 and you can't find the invoice for that, that's a red flag. And then just general problems with financial statements. Why can't we reconcile cash? Or why can't we, why do these ratios seem to be completely off of where they should be? Things like that should be addressed. Finding out why is always a good thing than to just let it go. And again, talking about employee behaviors, the thing to really think about when talking about employee behavior red flags is if employees have some of these issues, you don't want to necessarily, I'm not telling you to get rid of that employee, because we all have problems, right? I mean, let's just be real. Like, everyone's got family problems. Everyone has at some point in their life had a financial burden. We have plenty of friends or relatives who have addictions of some kind, whether it's gambling or something else. It doesn't mean they shouldn't have a job. So what we're talking about here is, if you have an employee who has these issues, what you want to go back to is that fraud triangle. And so they have that financial pressure, right? And maybe they have that rationalization. So what can we remove from that scenario is the opportunity. So if you have employees with these issues, they seem to be living beyond their means, they have financial pressure, they have gambling addiction, let's not put them in a position to where they have opportunity let's put them in a position to where they don't have access to cash. They don't have access to a lot of assets. They're not responsible for reconciling the bank account. These are all just ways to maintain employees and good employees and not let them have that opportunity to commit fraud. So polling question 2, what are some red flags to note in employee behaviors? Drugs, alcohol, gambling, living beyond means, dissatisfied with pay, all of the above or none of the above? All right, everybody got it right. Good job, 100%. Yes, it is all of the above. So just like we're talking about with some of the red flags to note for employee behaviors, drugs, alcohol, gambling, obviously that's a big one. Living beyond their means, again, it's always a big red flag. Now, a lot of people live beyond their means, and that's not a uncommon thing. But again, let's not give that person too much opportunity. If you ever see a combination of some of these, it's almost like exponentially increases that risk. So you want to always be aware. And sometimes you just don't know, though, right? There's sometimes you have those employees that have a drug addiction, have a gambling addiction, and you're just not aware of it. And that's just kind of the nature of the beast. But if you are aware, it's always important to not allow them to have that opportunity. So fraud, impact, and examples. And we're going to go over some kind of different schemes, things that I've seen. There are other schemes out there, and some of you may have had a fraud occur within your organization. And I may not discuss the specific scheme that happened, because obviously there's different schemes at different companies and different opportunities at different companies. But I'll talk about some of the ones I see and some of the more common ones as well. And so one thing I wanted to mention here before I get into those examples is the impact of fraud. And it's very, very prevalent when you kind of look at this chart, because again, and this is from the Association of Certified Fraud Examiners, about 53% of people who or companies who have a fraud occur recover nothing. And the reason for that is most people who commit fraud are not saving that money. So most people don't steal money to save it in a mutual fund, right? Or they're not putting it in their 401k. Most people are stealing that because they need it for something, whether it's like I said, financial pressure or an addiction. They're using that money up. So if you go to if someone has a gambling problem and they're stealing from you, and you find out, chances are that money is already long gone and been put into a slot machine. There are I would say so. There's 15% that recover all losses. I think I've had a few clients in my career that have actually done that, and it's pretty satisfying when that happens. But it's very, very few. And 32% make a partial recovery, and most of the time that partial recovery is in the form of an insurance claim. A lot of times law enforcement will get involved and they will get charged and they may have to pay restitution. But one, they probably don't have any money at the time. And two, once they get out of jail, making money is difficult. And even if you garnish their wages, you're talking about maybe they're going to garnish $100 a month out of their wages or something like that. So they're not going to get their money back very quickly. So partial recovery, but again, I would say most people fall into that 53% where they don't recover anything. Even those that make a partial recovery a lot of times that money ends up getting spent back into attorney's fees, other legal fees, and people like myself who have to come in and identify the actual amounts that were stolen and how it happened. So a lot of times that recovery amount is end up lost through other expenses. So while we're on that note, I will just stress the importance of having an employee dishonesty coverage built into your insurance policy. A lot of times it's not enough money, so it's always something to go look at. Most insurance companies, I think, are starting to, they usually, the least amount that we'll see is about 25,000 nowadays. Before it was even less than that. Some insurance companies will start it at about 100,000 for employee dishonesty coverage. I would say, the average theft that we have again is 150,000. Having, $250,000 to $500,000 would be great, depending on the size of your organization, because it's amazing how long that employee schemes can last and how much money can be stolen. So common schemes that we see in the construction industry, and these kind of go from most common to least common. Billing schemes is by far the biggest one that we see. And what do we mean by billing schemes? Really, it's a disbursement scheme. So people are fraudulently dispersing funds for their gain. Now, we see that a lot of times in misuse of, let's say, credit cards. If you have credit cards within your company, people misusing that, issuing payments for personal gain, whether it's they're cutting checks to themselves, which we often see. And a lot of times if they have access to the accounting records, they change the payee in the accounting records to conceal that they paid themselves. A lot of times we'll see them pay similar vendors that maybe they have themselves. So for example, utilities, if everyone in the city is paying the same utility company for or the same cable company for the same types of services, we've seen before where people who are in a position of paying bills will include their own personal utility bills with the company's utility bills and pay that through the company's bank account. And it goes unnoticed because they'll see, ABC utility company, we always pay them every month. That's not an issue, when they don't understand that they're paying two different bills on that payment. So that's something that we see quite often. Payments to banks or straight to cash are another one that we see, where those should definitely be red flags if you ever identify those items. Because if you pay a bank, you can obviously obtain cash. They can disguise that as a loan payment potentially, when really they're just paying the bank to obtain cash, or they're paying the bank to pay their own personal loan. So there are schemes that we've identified that way as well. One case in particular, I'll give an example, is very interesting. They were, it was a construction company, and the general manager for one of the locations was submitting his credit card bills for purchases that he made on behalf of the company in that location. And what he was doing is he was making personal purchases on the credit card. And what he would do, he would find old statements from the credit card. He would literally physically cut out line items in that credit card statement and that were legitimate from a previous one, and then paste it over the new credit card statement that has illegitimate charges. So he would let's say he had a charge to Best Buy for, and he bought a new TV for $1,000 on the credit card. He would go back to the an old statement, cut out a payment that was to Ace Hardware because that's a common vendor they were using, and he would paste that Ace Hardware one over the name of the Best Buy one, of the Best Buy purchase, and then he would make a copy of it, and then he would scan that and then send that into the company as the credit card statement. And they never got the actual credit card statements directly to the organization, so that was part of the issue. And then the other thing is he had to submit receipts for all that, which is a good internal control to have, right? But he would also doctor up receipts, so he'd find old Ace Hardware receipts, and he would doctor those as well and send those in. So he went to great lengths to cover up his fraud scheme. And finally, someone within the company, one of the receptionists saw one of the statements that was doctored, the original, and found out what he's doing and told the corporate headquarters. But it was he ended up taking close to $250,000 that way for personal purchases. The other thing that we see sometimes in these billing schemes are payments to fictitious companies. So they create a company. It's pretty easy to create a doing business as and set up your own business with your own social security number. I think it costs like $50 to go to the state and do something like that. And what people will do is they will create a new company that has a similar name for a vendor that the company uses. So for example, if you are, as a company, always paying a company called Construction Supply Inc. because they're a common vendor that you use, I would maybe go and set up a company called Construction Supply Company instead of Inc. or Construction Supply and Tools or something like that. And when I would just submit these fictitious invoices for this company, and I would take those payments that are made and authorized and deposit it into the bank account that I created for that fictitious company. So that's one other weird way that we've seen that happen. And some of these can be very difficult to catch, but having internal controls in place, and we'll talk about that, will help identify those items. Expense reimbursements are another area that we see a lot of. Usually it's, inflating mileage. If you look at hotel bills, people are traveling, they have to submit expense reimbursements. They're submitting their hotel bill, but within that hotel bill, there might be hotel charges that are unauthorized, like room service or other charges to the hotel. And those items sometimes go unnoticed. We also identify, meals, things like that, where people are submitting expense reimbursements. They're saying they're taking out clients or potential clients, and really they're just taking their family out for dinner. We see that quite often as well. One thing that we also see is a double dipping. So where someone will charge an expense to a credit card, a legitimate expense to a credit card, and then they'll submit an invoice the same invoice separately to get an expense reimbursement. So, if they already paid their hotel bill on the company credit card, and then they submit the same hotel bill separately, we call that double dipping. And we see that quite often as well. Non-cash schemes that we see very common in construction: inventory theft, equipment theft. We see a lot of people who don't have they're secured their equipment, people using equipment for personal use that's unauthorized. There are a lot of companies out there that allow that for employees to utilize equipment for personal use. They just have to go through process of checking it out and making sure it's full gas and things like that. But there are a lot of times when people utilize construction equipment for personal use, and I'm sure all of you have kind of run into that or seen that. It's pretty common, but it is fraud. It is use of equipment without an authorization. So we see that quite often. And theft of inventory. We have a lot of construction companies maintain a lot of supplies in a big warehouse, and there are people in and out of that warehouse, and things can go missing. We had one client who had a lot of shrinkage, within their inventory, and every time they did their inventory counts, they had excessive shrinkage, like 10, 12% every year, and they couldn't figure out how to get that down, and just because they were a smaller construction company and they couldn't afford security cameras. So we actually made the recommendation to install fake ones, because sometimes just having that perception of detection will deter normal people from stealing. And his shrinkage went down 6% the next year just from having fake security cameras that blinked. I think each one had like a AA battery in it, and it just blinked to make it look like there were security cameras. So things like that can really help. We'll talk more about that too here at the end of the presentation. Payroll schemes. Payroll is another area that I think not just common in construction, but really in every industry. I'll give you an example of one that we had out in, I believe it was Wyoming. And what happened was, this is a construction company, and they had what's called a ghost employee scheme. And some of you may know what that is, some of you may not. But what happened was, there was a foreman that was in charge of a crew for construction, and 2 of the employees had quit. What he did was he did not let the company know that they quit, and he began to fill out fictitious timesheets for those 2 employees. Now, the checks would get printed, and some people had direct deposit. Some people in construction, they prefer to have checks, and or they don't have a bank account, so they prefer to get check payments. But he would take the checks and he would tell them, no, you know what, they don't have a car. I'll bring this out to the work site, and I'll hand this to them personally. So he would take the checks, and what he did was he made a deal with these guys on the side. He asked them to each open up bank accounts in their name, and which they did. And in turn, he would hire them on his ranch. So he hired them on his ranch to work, and they had opened up these bank accounts which they never used, but they had given him the debit card for those accounts. So what he would do is he would take their checks, he would night deposit checks into those 2 individuals' accounts. So those accounts would get funded by the company with these fictitious timesheets that he was submitting. And then he would take the ATM cards he was given, and then he would withdraw cash from ATM. And he was able to take almost $300,000 using that scheme over the course of 5-6 years. And really, it was kind of an interesting deal, because they had always questioned why they never saw those employees, but they never questioned the foreman, because they thought he was a very trustworthy guy and he'd been there a very, very long time. So how they identified it really was, they had kind of, once an investigation started, they were able to see him through the ATM cameras coming up and withdrawing the cash, so they knew it was him. So on to the next one, corruption. Again, this is pretty common within the construction industry. Usually when we talk about corruption, we're talking about bribery or kickback schemes. I'll give you another example of one that we've worked on before. We had one client call us who identified that, well, how it happened was, one of their controller was trying to buy a new loader for the company, and he really wanted a brand new loader. The owners said, no, we don't need a new loader. We have good equipment. It's fine. It's older, but it works. We don't need to spend all this money on a new loader. He kept fighting and pushing it, and they thought it was very weird that he really, really wanted this new loader. What they ended up finding is, through the network emails and on his company email, that his friend had worked at the company that he was trying to buy this loader from, and he was a salesman, and he was going to kick him back thousands of dollars in gift cards and also an Apple computer. So his motivation for buying this loader was to basically receive a kickback scheme, get a kickback from his friend who was the vendor. Now, I realize that people often get gifts from people that when they buy things from them. Now, this one was different because, one, they didn't need a loader, so he wasn't really following his fiduciary duty with the company, right? He wasn't making decisions in the best interest of the company when they had equipment that worked fine the way it was. His whole purpose there was to try to cost the organization some money so he could receive benefit, right? And that kind of goes back to our definition of fraud. So that would be an example of a kickback scheme that we've seen. So those are some of the more common ones that we see in the construction industry. We do see other small things, but I would say those are by far the biggest ones. Billing schemes, expense reimbursement, non-cash, those would be the big ones. And then occasionally we'll see a payroll scheme and some kickback schemes. So polling question 3, true or false, 53% of frauds are never recovered. All right, so the answer is true. 53% of fraud is never recovered. If you remember that slide that we saw a few slides back, 53% never recovered, 15% will recover all of it, and then the remaining percentage would have partial recovery of the fraud scheme. And again, I would definitely say 15% recovering all of it has not been my experience. It's usually way less than that even. So what are my options? I'll kind of burn through this part. It's if you were to actually identify a fraud, I want to make sure that you kind of understand the process you need to go through, at least some guidelines, because some people do make mistakes in this area. One, you want to make sure you act quickly. You are limited in time both by insurance claims and sometimes through law enforcement. So you want to make sure that you act quickly and you're not sitting on it for a long time or not doing anything. You want to make sure you gather information. So if you find out, there may be an issue and you think you might know what the scheme is, get that documentation, try to find as much evidence as you can on your own to try to find additional proof. And then utilize consultants like myself, if you have an internal counsel attorney or an external attorney, get their advice. Even if it's just your tax preparer, get their advice. It's very important that you utilize consultants in that situation. Things to not do, and they're very important. One, do not make any accusations, because that can then turn into something bad if that accusation is false. Do not discipline them yet. Make sure you do your due diligence before you do anything as far as disciplining them, putting them on unpaid leave or firing them or demoting them or whatever it would be. Do not show them the evidence you might have. We have too often run into situations where someone will find a fraud and they will bring it right to that person and show them the evidence, because the first thing that person is going to do is walk away, get an attorney, and come up with an excuse and fight you on it. The first thing you should do is definitely gather more information. Paid administrative leave is an option until you can correct the situation, although I wouldn't even go there until you have more information. So the main goal is anytime you have identified that there is a fraud, you want to make sure you identify how much you've lost, because you can't recoup those assets, which is another goal, unless you know how much you've lost. You want to avoid liability. So again, going back to not accusing anybody, because the last thing you want are wrongful termination claims, slander, defamation claims, or because a lot of times people will just plead ignorance and they'll just say, I'm a bad accountant, I accidentally did this, there was no intent. And remember, when we talk about fraud, in court, you will have to prove intent. And it's very difficult if they're just saying they're a bad accountant. And then know your end game. Are you trying to make this person go to jail? Because there's different processes and ways of going about each scenario depending on what your plan is. I have had clients that would go to whatever length it took to make sure that person got convicted, meaning that they would pay attorneys and people like me whatever it costs to make sure we had everything squared away, that they could definitely get jail time because that's what they wanted. We have some people that they don't care about pressing charges. They just want to get their money back, and if they can get it through insurance, they'll be just fine, even if they can just get a part of it through insurance and they have no intention to actually charge that person with theft. So know your end game. And then just quickly to prove fraud, remember it can only be proven in the court of law. Even I can't say something's fraudulent. It's got to be a jury or a judge to actually to indicate that something's fraudulent. You have to prove intent to conceal that that was done willfully. Simply proving that assets were taken, that doesn't prove fraud. You have to show that there was intent. And ways you can prove intent are through witnesses, obviously. If you find any other evidence like correspondence through email, confessions, If they're a bookkeeper and you see that they paid a check to themselves, but they changed that payee in the books to look like somebody else, that would be another example to prove intent. So frequency is a big one though, because a lot of times they say, oh, I didn't mean to put that personal charge on the company credit card. Well, if they did it 400 times, it's probably a way to prove that it was intentional. So last polling question. What are some ways you can help prove intent? Frequency, witnesses, correspondence confessions, receipts and written notes, A and B, or none of the above? All right, nice work. Yes, A and B would be the best answers for this specific question. Like we talked about, have a frequency, identifying that. The amount of times can obviously prove that it was an intentional act, and obviously having witnesses or giving confessions and things like that is great. So this is the best part, I think, where you can maybe take some of this information home with you. And what I've done is these are internal control recommendations to really prevent fraud. And I kind of tiered them into 3 different tiers. And tier 1 would be the inexpensive, easy things you can do to prevent fraud in your organization. These are cheap, they're simple, and they're effective. So having a written policy manual and employee handbook is, and actually having what we would call a fraud awareness section is extremely effective. If you have annual meetings with your employees and you go over the fact that this is what fraud is, this is what will happen if you commit fraud in our organization, please sign here. They will know right then and there that you are serious about fraud and you're not taking it lightly. And that is a huge deterrent. So just having a good written policy, fraud policy, is excellent. Having good credit card or purchasing card use policies in place. A lot of times people will just say, oh, I didn't know I couldn't do that with the credit card. Having good policy in place outlining that is a good internal control. Doing background checks on employees. Obviously in construction, you get a lot of laborers that, yeah, they do have criminal histories. But again, it just comes back to making sure they don't have the opportunity to do anything effective. And if they do, making sure that you are doing independent checks to help prevent any issues or deter them from having any fraud schemes. Having an anonymous reporting system like a fraud hotline where people can call or submit online anonymously would be the key there, because a lot of people are afraid to report things if they think that their name is out there. But if you have an anonymous way that people can do that, and there are fraud hotlines out there, Eide Bailey does offer a fraud hotline, but there are a lot of different ones out there, and that's a good way to receive tips, because over 40% of frauds are identified through tip rather than through an audit or anything else. Adequate records and making timely deposits are other easy things to do that don't cost much money and are effective. As for the second tier, a little bit more expensive, but again, very effective. Conducting regular inventory counts. You want to make sure you do that. You want to know what your shrinkage is. You want people to understand that you do take inventory. You are counting your supplies. You are counting your equipment. Physical security over assets. We talked about, it's just having locks on the doors, having a fence around the yard where you maintain large equipment, having one entrance in, one entrance out, or maybe you have to have 2 entrances for fire codes or something like that. But making sure that you have those security cameras and things like that. Physically securing your assets is important. Reducing the amount of cash on hand. We're kind of in an age now where there is less and less cash, but there are still those organizations that hold a lot of cash. And the longer you have cash in your company and not in the bank, the more ripe it is for fraud. Verifying vendors before you make a purchase with them. So making sure you get your W-9 from the vendor before you actually pay them for an invoice. Making sure you do just a simple Google search. Do they have an actual address? Are they a real company? And then proper authorizations and approvals when necessary. Are we getting the appropriate signatures? Do we have the review policies in place? Do we have purchase orders that are signed and initialed, or whatever control you would have? Making sure you follow through with those. And the third tier, more expensive, because a lot of times this involves, hiring additional employees so that you can add that extra layer of controls and review and independent checks. Really comes down to separation of the what we call ARC duties, which is authorization, recording, and custody of assets. So if you are authorized to disperse funds, then you should not be recording that disbursement. You should not have custody of that money. So that's kind of that thought process there. You want to make sure you do that in both in accounts payable, accounts receivable, and in payroll. Those three duties are separated. And having annual external audits, that is a very good deterrent for people to want to commit fraud. If they know that they're getting audited every year, people tend to be deterred from committing fraud. Having good management oversight. And, in construction, a lot of times you may have owners that are passive owners. They're, they put up some funds and capital for the organization to operate, but they're not overseeing anything. You want to make sure you have good owners involved who are actually, rolling up their sleeves, reviewing some bank statements, some financial statements, asking those questions. That always results in less fraud risk. And having restrictions within your accounting or point of sale software. So, that not everyone has the same username or password to get into the accounting. Not everybody who can get into the payroll module within your company can also access other modules within that accounting software. You want to make sure those are separated so people don't have the same access. And a lot of times that means upgrading to a new system, which again can be costly. So those are the three tiered items. Again, there's tier one, less expensive, easy to implement, and very effective. Tier two, a little bit more expensive, but also effective. And then tier three, ideal, but can be expensive. So that is the end of our presentation for today. If anyone did have questions or if there was any questions, I'd be happy to answer those.
Alrighty, I don't see any questions coming off and people are signing off. So thank you guys for attending and thank you, Brett, for hosting, and everybody have a great weekend.
My pleasure. Thanks, everybody.
Bye.